Seth Golden, it's been too long. Welcome back to F.A.C.E. How are you?
Hi, Dale. Good morning. Thank
Hey,
you for.
buddy. Good to have you back. Every once in a while, I just start scheduling people, and I forget to get the good people back in the rotation. I'm so glad that you're open to coming back. It's been a while since we talked. You've used Zoom before, right, Seth?
Yes, I have.
All right,
Yes.
so you could share your
Daily.
screen now. I don't think we have to go back through your history and how you got involved in the business. Getting some nice Twitter action from some of your fans, from talking about your company. And I'm curious what's on your radar. Right coming into this week, the end of the month. I don't have a lot of ideas, at least right now. I'm wondering, and it sounded like most of the team kind of felt that way too. What's on your radar going into
I think
month end?
the list of what's not on my radar is a lot smaller, so that's probably
Okay.
there's nothing that's not on my radar. You guys were chatting up earlier about having resources and having a team, and that's something that I've fostered throughout my career. I've just always felt like the more information that you have at your fingertips, and the more feedback systems, the better off you're going to be long term as an investor or a trader. And that's something
Yeah.
that we promote at Phenom Group with our members. And every week, what you're looking at here on my screen is something that we send out freely to the public and our free members at Phenom Group. And it's basically what we call our weekly Nifty 9.
Okay.
It's an extrapolation from our Sunday research report. We issue a full-scale research report every Sunday that entails everything. That's why,
And what?
when you ask the question, what's on my radar, my members are probably saying, man, that's just the wrong question. The guy, he's got everything on his radar, which is
What's
why.
the 9 stand for, Seth, in the Nifty? I know it's kind of a take off on the Nifty 50, but
Right. Right.
what's the 9? Is it 9 mean 9 key markets or
It's
stocks or?
nine key charts, 9 key extrapolations from our weekly research report.
Okay.
Just some easy to decipher, some analytics, if you will. The first one that you're looking at here, again, research report excerpt number 1. We've been monitoring this analog since the bottom of 2020. This is the S&P 500 going back to the green line is 2009 to 2010. And
Okay.
the orange line is 2020 to 2021. And so you
Okay.
can see how we've tracked the 2009 into 2010. This is the crossover into 2010. You can see how we've tracked the bottom of the 2009 market very, very closely. Until most recently, this is the widest divergence that we've had. And this box indicates that divergence here now is about 27%. So we're still traveling along the same path, but from time to time, we're essentially on a different time plane when it comes to the analog. So we've kept this in focus since about April 2020, and it's been a very, very useful tool in terms of just looking at the market from a quantitative perspective and kind of drowning out the noise of the financial media.
Yeah, interesting analog and really closely. So, that's kind of saying when you have to be prepared for some risk off if that analog continues to work, right?
Yeah, this drop here, this initial drop in May coincided with, and I'm sure you and your members and everybody that's tuning in recall, that was the start of the May flash crash, which ultimately resulted in about a 16% correction in May through June, early July of 2010. So if there's going to be a deviation, we would say initially it would stem from, some of the new implementations that would offset the probabilities of a flash crash this go around. So you would the market would demand some kind of catalyst outside of a flash crash to bring this dip about.
Okay. All right. Yeah, that's interesting. So yeah, I'm trying to remember that flash crash that many years ago. I have old timers disease. So anyway, so you have to keep an eye on that. And you're saying the difference between 2010 and now, maybe it's the Fed.
There's definitely, 2020's monetary impulse is some 3 times greater than 2008, 2009. So there's definitely, you have to factor those in when you look at an analog like this and you see the consistency between the past and today. You recognize human behavior, is pretty consistent, even though the variables in the market or in the macro are always unique. They're always different. What causes this, that, and the other is always different. But the market is basically your extension of human behavior. So when people, look at an analog and they say, yeah, but, the Fed this, or the federal government's fiscal policies that, I say, that's all well and good. But the market is an extrapolation of human behavior, and human behavior, as shown in the analog, tends to be very, very consistent. Therefore, even though the variables may change and the magnitude of the variables will differ, it doesn't exonerate the possibilities.
Okay. Nice look. Appreciate that. So what's number 2? What are you looking at here?
Yeah, so number 2 we have here something that we looked at back when this signal fired. It's the percentage of stocks trading above their 50-day moving average. And this chart this table comes to us from LPL Research. And when we get 90 or greater than 90% of S&P 500 index components, the stocks themselves trading above their 50-day moving average, the forward-looking returns are rather strong. 1 month out, 3 months out, 6 months out, 12 months out. The last time this fired was in May of last year. So here we are a year later. Did we do 15.9% since May 26th here signaled at the bottom? And of course we have. We've done a lot more than that, actually. Right. But what struck us is that what you don't see on the table here is what we discovered in our research over the weekend, which was on April 14th. Yeah, here's the date in this chart, if I can align. April 14th, this signal fired again. Now, if you look for this in social media or wherever, you're not going to find it. So it was widely overlooked, because it was just one day that this got back above 90%. So essentially, we have another breath thrust that fired, and we have to add this to the table and quantify forward. Because again, these quantitative studies help to alleviate a lot of the noise that's out there in the financial media, which, kind of creates this vacuum for investors to fall prey to when it comes to all the negative commentary and potential pitfalls for investors in the market. So this signal, again, just fired in April. So what we would do is add it here and look to, the 1 month, 3 month, 6 month, and 12 month. More importantly, it's not the actual average returns, but the percent positive rate. 1 month later, the market is higher 72% of the time. 3 months later, 90%. So on and so forth. And this is a way of, we look at you have fundamentals, you have your technicals, and you have your quantitative data. I've always believed in having multiple disciplines. And this is a way of achieving those multiple disciplines, having, these various studies and quantitative data points. And this one, allows the investor, the average investor, retail trader, if you will, to basically align their portfolio, align their sentiment with the probabilities going forward, instead of well, this person on CNBC says this, and this person on Bloomberg says that. This drowns out the noise because it's quantitative, it's black and white. You can't argue with it. It doesn't speak to sentiment. It speaks to, market history.
Okay. Interesting.
Number three, and we've the NASDAQ, right? Tech and the NASDAQ, growth stocks, they've been underperforming for many months now, if not a couple quarters. We've seen value, we've seen cyclicals, all of that aspect of the reopening trade and the reflation trade outperforming what investors had gotten used to over the last decade, maybe 11 years, which is tech and growth outperformance. So one of the charts that's been on our radar lately is the NAMO, which is the acronym or ticker for the NASDAQ McClellan Oscillator. And the reason this has been on my radar, along with other NASDAQ, various breadth indicators, is because I'm not of the opinion that we're going to enter this new paradigm of value outperformance, maybe for the next decade, or financials outperforming for the next decade. So I keep a watchful look. Mm-hmm.
Why not?
Money in the market follows earnings. It follows safe earnings, if you will. And eventually, tech is still going to deliver that. What we found over the last 2 quarters is the realization of yield. Where can investors find the greatest yield? And I think what gets lost in this whole equation of value versus growth and where can investors find the greatest yield is leadership and the concept of identifying leadership. It's all about your starting point. So if we take our starting point and we acknowledge that the new cyclical bull market started in April of last year, well, what led us out was technology, was growth. And why? They have the most clear or visible forward-looking earnings. They have the greatest free cash flow, and they led the market out of the bear market territory. What happens next? Well, once you realize the forward-looking yield, investors basically gobbled up those forward-looking yields in tech, in growth. Well, what was left was high valuations for growth. So now the rotation begins. Where's the next leg? Well, it's the economic recovery. And so now the greatest yield as of maybe September, November of last year came from the reflation trade. It came from cyclicals. All the yield had already been absorbed in tech and growth. So now they start consolidating. Tech led us out of the bear market. Tech led the consolidation phase. Tech, in my opinion, tech and growth will eventually lead post the consolidation phase into the mid-cycle portion of the new bull market.
How about that tech led the recovery and tech could lead a bear market?
It certainly
lead the correction.
Yeah, absolutely.
So, isn't that a possibility? And when you think about it, it really was the catalyst for the huge recovery after the COVID crash and its underperformance, maybe as a market message or market tell that when leadership becomes the laggards, that there's possibility that it could lead a decline in the market.
There is that possibility, which is why I would lean on the fundamental side of the equation that says this is normal and to be expected. Technical tech/growth consolidation, because the earnings are not showing any divergence. They're not showing the propensity going forward for deteriorating earnings growth, but rather accelerating earnings growth. And the composition of tech is also showing that same thing. There's no true divergence there. There's just normal and to be expected, if not garden variety, consolidation taking place here.
Okay.
So that's just my opinion, of course.
Okay.
An exogenous event is beyond my scope of analysis. That's why it's, black swans and things of that sort, you can't really, forecast if it falls into it, but it falls into the realm of possibility. So always keeping an open mind and flexible approach to my analysis.
It is the longest bull market.
Proved prudent, if you will.
Yeah.
So going back to
this
this NAMO indicator, what we've seen recently is that it hasn't made a lower low since the March 12% correction in the NASDAQ. It hasn't made a lower low. And right now it's putting in somewhat of an inverse head and shoulders pattern and trying to get back to these better levels that it's been in the past. In my opinion, this is starting to show signs of tech outperforming once again and maybe taking back the leadership role. One of the things that I always lean on when it comes to any forms of technical analysis is, technicals tell you what happened in the past and what is developing. They don't, they're not forecasters. You're just using past and developing situation to draw some level of conclusions and expectations going forward. So this is a chart that's definitely on my radar. And as of this morning, futures look, like they are pointing higher. For those that are not familiar with the McClellan oscillator, it's a form of the advanced decline lines, 19-day exponential moving average and the 39-day exponential moving average there. Advanced decline line for short, if you will.
Okay.
And another reason why I think technology is going to start recapturing that leadership is something that we saw last week in the market on Wednesday with the semiconductors having that intraday reversal. As we all might recall from last Wednesday, we started down in negative territory, gapped down pretty sharply on all the major averages, NASDAQ especially. But all of a sudden,
NASDAQ came back the best. Yeah.
Yes, semiconductors actually led the way in a big way. And there's various industries within the information technology sector. You've got your semiconductors being the largest, then you've got cloud computing, you got software, and you've got cybersecurity. Well, if those areas of the technology sector are going to start to move higher, you're going to need your big boy, your SOX or your SMH.
Right.
Those are your sector ETFs, if you will. You're going to need them to show their strength. And that's exactly what happened. We had this outsized reversal candle intraday. We're down more than 2% to start the day and rallied to be green on the session. And so this was, on my radar. This is something that we introduced into our weekly research report because we want to know, after this happens, how do semiconductors, fare? How do they perform going forward? And that's what this study tells us. On average, the SOX posted a net gain of 1.7% in the first 5 days after days like Wednesday, which is a little more than the 4 times the size of its average 5-day return of only 0.37%. So, by and large, this is basically saying that we may have hit, somewhat of a trough near term in the semiconductors, and they have been higher since.
I think that was a key event last week.
Yes. Yeah, I think so. Of course, anything can happen. A lot of variables to consider. But again, in terms of the quantitative data combined with some of the technical data, we are seeing the signs of capitulation maybe in technology or growth areas of the market where now it's possible you can make the rational argument now that the yield absorption has been had in industrials, materials, chemicals, value. And so the market is having this kind of tug of war with itself right now. We've already extrapolated the yield in technology and growth last year. Now in the first 5 months of the year, we've extrapolated all the yield in the reflation trade, the cyclical. So where Where does leadership come from now? And so we've had basically this 6-week consolidation in the S&P 500. We've hit new all-time highs, 42.38 in the S&P, but if you go all the way back to the beginning of April, we're right back to where we were.
And all right. Well, you know what I'm kind of getting from this, Seth, is almost everything that you've talked about, besides the analog, is very constructive. And the analog is saying that the market is ahead of itself and due for some type of decline. What do you put heavier weight on?
Earnings. I always go back to, I'm kind of a believer in the, Larry Kudlow's earnings are the mother's milk of markets.
Yeah. Okay.
And as earnings go, the market will follow, if not immediately, over time. And just thinking long term, something that I often talk about with our members at Phenom Group is act locally on price and in accordance with your game plan. Act locally on price, but think long term. So if you're taking action on any particular stock, ETF, on your watch list or as part of your game plan, make sure you give yourself, enough time in that trade and or investment in case we do see greater consolidation. But when it comes down to it, you can see that the earnings estimates have been woefully too low. Year to date. You can see from where we are right now, the consensus forecast for 2021 EPS is 188. Yeah. We started at 173 as we were starting the first week of earnings season with the financials. It's now at 188. This will finish with a 190 handle by next week. And when we're basically out of the earnings season, that is a substantial, it's almost a 30% jump in full year earnings expectation versus where we came into the year. And it's not over. I'm of the opinion that we're probably going to have somewhere in the area of 210 to 215 in earnings per share for the full year. So while the market may have gotten ahead of itself for now, that's your, I would say that's your benefit. If the market wants to consolidate that much more near term, the earnings trajectory suggests that it's to the average investor's advantage to take it, to buy the dip, so to speak, or for lack of, a better phrasing.
Okay. All right.
How does the Fed fare? How does the Fed play into this? Again, thinking more macro, political.
How about this? Yeah. How about this? We're getting a comment from one of our viewers. How are earnings going to go when the stimulus checks end?
So here's something that's been widely not under the radar, but it just had, because there's so much noise about inflation and when is the Fed going to taper, I think a lot of folks have forgotten there's more checks coming. Child care tax credits are going to start to roll out in July. The average household, if you have one child under the age of 18, is going to get $300 to $350 a month until December. So imagine if you have 2 children, which is the average household in America. 67 million families in America are going to get upwards of $600 a month in additional fiscal stimulus. That money that used to go to, and I can speak from my own experience. I have a 5-year-old and I have a 3-year-old. My 3-year-old goes to daycare. My 5-year-old is going to graduate kindergarten. So I've done my job and now she can go to work. Of course, just kidding. But my 3-year-old, I pay $500 a month in daycare. Right. So that is a boon for the average household. Where do you think that money that used to go to paying daycare cost or, whatever other kind of childcare cost is going to wind up? Well, we're consumers. It's going into the economy. One way, shape, or form, it's going back into the economy. So in the sense that where is the market, where are those earnings going to go? when the fiscal stimulus ends, when the checks ends, we're still far away from that. We're still far away from that.
And how long will that last? Till year end?
Yes, those go until December.
Okay.
Yeah.
Merry Christmas.
Yeah, exactly.
All you mothers and fathers out there, Merry Christmas.
Yeah.
Okay, so you really have some great insights and things that a lot of people don't look at, Seth. So maybe you could use the next couple minutes for letting people know how they can reach you and
Yeah,
via
absolutely.
Twitter and your website and your newsletters. Talk about your business model here.
Yeah, so you can reach us at phenomgroup.com. We have 3 levels of membership: basic, which is free, which gets you access to some of our free weekly content. We have a contributor and premium memberships, which give you access to all of our research reports that we send out weekly and our state of the market videos. Again, very, very detailed reports, which can run, and our research is actually white papered by some of the biggest institutions in the entire world, including hedge funds, Wells Fargo, Credit Suisse, Hightower Advisory Group, the list goes on and on. Very, very detailed charts, analytical studies, quantitative data, economic data we dive into every week, the earnings outlook every week. And then, of course, we have a wrap-up segment here, just kind of looking forward. We're getting into the time period between Memorial Day and Labor Day. Well, how does the market perform? We have all of that. We don't leave any rock unturned. On Twitter, you can find me at here. There you go, at Seth CL. And I usually put out, a good 10 or so tweets a day. Some of it is within our research and what have you. And others are just, thoughts on my mind.
Yeah, well, I'll tell you what, everyone, to prepare and write all of this research, it doesn't just happen. It takes a lot of hard work and a lot of time and energy. And Seth, you definitely demonstrate a passion for keeping your people informed and, like you said, looking at everything. And I want to thank you for sharing some of your work with us today, and hope
Absolutely,
you have a great I hope you have a great summer trading season. And it was really nice to see you and talk to you again, Seth. I appreciate your time today. Thank you, my trading warrior brother. All right. All right. So everyone, Seth Golden. Thanks, Seth. You're getting people. Monica said you were interesting. We won't give out your phone number. And thanks again, Seth, for being with us today, and good hunting. So I guess Seth. Okay. All right. All right, everyone. So we'll see you for Turnaround Tuesday tomorrow. And you could join the team in 15 minutes for the morning edge. Good hunting. Remember, don't just count your economic statistics, count your blessings. And see everyone tomorrow. Thanks again, Seth Golden. Adios.